Welcome back to Gold Rush Reporter, your trusted source for real-world gold and silver analysis that cuts through hype and gives you the truth straight. Today, I want you alert, focused, and paying attention. Because what's happening right now in the global gold market is something most people have no idea about. But it will directly affect every investor. Before we get into it, let me ask you something that deserves an honest answer. When you think about gold demand, do you imagine a few countries buying some bars? Or do you actually understand how aggressively the world is shifting toward physical gold? I'm asking because too many investors talk about gold like it's a niche product, while in reality, the demand across the world has quietly exploded. And if you still think gold is moving slowly, or demand is stable, then you're already behind the curve. Tell me in the comments, did you expect global demand to be this strong or not? The truth is simple. Gold is no longer just an investment. It has become a survival tool for governments, banks, and normal people who don't trust their financial systems anymore. And the countries leading this shift are not small players. We're talking about India's massive jewelry demand, China's aggressive buying behavior, and the Middle East continuing to treat gold as the backbone of long-term wealth. This is not a trend, it's a structural shift. Think about China for a moment. Their citizens buy more gold than almost any population on Earth. Not because it looks nice, but because they know what instability feels like. India's gold demand is so powerful that even small changes during festival seasons can move international prices. And then you have countries across the Gulf where gold has never stopped being real money. When these regions increase consumption at the same time, the global market tightens fast. This is where most analysts miss the point. They look at charts, indicators, and short-term price swings, but they completely ignore real-world demand pressure. Look at the last 2 decades. Every time global demand spikes, prices follow shortly after. Supply can't keep up forever, especially when the buyers are not speculators, but millions of people who plan to hold long-term. That is exactly why physical premiums rise immediately, because dealers feel the pressure before the price charts even react. What you should be asking yourself right now is, why are all these regions increasing their consumption at the same time? Is it inflation? Is it currency fear? Or is it simply that people no longer trust their governments and banks to protect their wealth? Whatever the reason, the signal is clear. Gold demand is rising everywhere. And this creates long-term price pressure that no analyst can ignore. This is just the surface of what's happening. In the next part, we go deeper into the second major force reshaping the gold market, the tension between miner supply and real-world demand. If global demand is the force pushing from one side, then the real pressure comes from the opposite direction, the mining supply that simply cannot keep up. Most people assume gold supply is easy, predictable, and steady. It isn't. In fact, the mining industry is facing one of the most serious slowdowns of the last 20 years. And this mismatch between demand and production is exactly why gold keeps grinding higher, even when price charts pretend to cool off. Let's get brutally clear. The world has already discovered most of the easy gold. The high-grade deposits are long gone. What's left are deeper, lower grade, more expensive, and more politically restricted regions. That means miners extract less gold while spending more money. So even if the price goes up, they aren't producing dramatically more. There's no surge coming. There's no magical supply wave that will bring prices down. You will not see supply suddenly double. That era is over. The problem becomes worse when you look at the long-term data. New gold discoveries have collapsed over the last decade. Think about what that means. If discoveries are drying up now, production drops later. It's a delayed impact, but it's unavoidable. A mining project takes 10 to 15 years to move from discovery to actual production. So the shortage we see today, it's baked in. It's the result of decisions made a decade ago. You cannot reverse that instantly, no matter how high prices go. But here's the part most investors completely misunderstand. Miners don't operate on price hype. They operate on economic viability. If costs are rising faster than gold prices, they slow production, not increase it. And right now, operating costs, fuel, labor, equipment, regulation, taxes are all rising aggressively. Some mining regions in Africa and South America are now so unstable that companies don't even want to expand operations. Why risk billions in a country where the government might change overnight and take everything? This is where the squeeze becomes obvious. Global demand is rising, but the physical supply pipeline is tightening year after year. You can't mint coins without raw metal. You can't fill bars without stable supply chains. When refineries struggle to get consistent feedstock, premiums rise. When premiums rise, investors panic buy even more, which reduces availability again. It's a feedback loop. If you've ever wondered why dealers suddenly run out of certain products, even when the charts show a steady gold price, this is why. The paper price may move slowly, but the physical market reacts immediately to supply stress. And when supply is limited, the first thing to spike is premiums, not spot. Anyone ignoring this dynamic is basically blind to how the real market works. You need to ask yourself, if the world hasn't discovered major new gold deposits in years, and existing mines are declining, what exactly will refill the global supply in the next 5 to 10 years? Because demand clearly isn't slowing. That imbalance is the foundation for long-term bullish pressure. Far stronger than any technical indicator. Central banks are quietly rewriting the rules of the gold market, and very few investors are paying attention. You see, when most people think of gold, they picture coins, bars, or ETFs. But the real power isn't in retail investors. It's in central banks, quietly moving huge amounts of metal behind the scenes. Over the last decade, the world's central banks have become net buyers, a complete reversal from the 20th century when they were often net sellers. This shift changes the entire supply-demand equation. Let's break it down. Central banks are not buying gold because they like shiny things. They are buying it as a hedge against currency risk, inflation, and geopolitical instability. Think about it. Every time a government prints more currency, the value of that currency erodes. Physical gold does not suffer the same fate. It is the ultimate risk-free asset when the world's fiat money is losing credibility. The scale here is massive. We are talking thousands of tons moving quietly each year, often at prices far below the spot price that retail investors see. This means the physical market available to you and me is tighter than the headlines suggest. Now consider the effect on premiums and availability. When central banks scoop up large quantities of gold, dealers have less to sell to the public. That's why you see sudden shortages of coins, bars, or specific bullion products. Premiums spike and the average investor panics. But the reality is this. It's not speculation causing the spike. It's the underlying shift in ownership from private and retail hands into central bank reserves. These are not temporary moves. These are strategic long-term acquisitions. The story is similar with silver, but with an added twist. Industrial demand for silver is surging because of technology, solar panels, electronics, and even emerging fields like electric vehicles. Unlike gold, which is mostly held for investment, silver is used. That means any disruption in mining or supply immediately affects both industrial users and investors. Imagine a market where both the physical demand and industrial demand compete for the same limited metal. That's a recipe for sharply rising prices and unpredictable premiums. Here's the catch. Most retail investors still focus on charts, technical indicators, and short-term patterns. They don't see the underlying forces. They get trapped, waiting for pullbacks or safe entries, while the actual structural pressure keeps building. Central banks don't play by the same rules as traders. When they buy, they absorb huge quantities quietly, and the market feels tighter even if the price appears stable on paper. Those who ignore this are always late to the move. The conclusion is unavoidable. You cannot rely on traditional trading signals alone. Understanding supply constraints, central bank actions, and industrial demand is critical. Physical possession matters. If you wait too long, you may find that your preferred coins or bars are unavailable, and premiums have already jumped. This is exactly why many investors underperform even when gold and silver markets soar. They miss the fundamental shifts that drive long-term price action. In the next part, we'll analyze the most overlooked risk factor in precious metals investing, counterfeit and fake coins, and why knowing how to detect them can save you thousands. One of the biggest dangers in precious metals investing today is counterfeit and fake coins. Most new investors don't realize how prevalent this problem is, and even experienced collectors sometimes fall for sophisticated fakes. It's not just about losing a few $100s. A high-value gold or silver coin can cost tens of thousands if bought unknowingly from a dishonest source. Knowing how to identify authentic coins is a skill every serious investor must develop. Start with pre-1933 gold coins. These are historically significant and very collectible, but they're also a prime target for fakes. Some counterfeiters take gold from other sources and shape it to resemble rare coins, making them appear legitimate. Others use plated metals over cheaper bases, creating coins that look and weigh correctly but aren't pure gold. Even small differences in thickness, edge design, or weight can reveal a fake, but this requires careful inspection and experience. Many people buy these coins online without seeing them physically, which increases the risk dramatically. Silver has its own challenges. Slabbed and graded coins are often marketed as premium or special, but some of these are designed purely for collector appeal, not metal content. In some cases, the grading is inaccurate, or the slab itself is counterfeit. Raw silver coins may seem less exciting, but they are safer for most investors. These include ungraded Morgan dollars, peace dollars, and junk silver like pre-1965 half dollars, quarters, and dimes. They have intrinsic value and are much less susceptible to scams because the focus is on metal content, not collectible design or packaging. Professional coin dealers use a combination of physical testing and observation to authenticate coins. Weight, dimensions, magnetism, sound, and visual inspection all play a role. Some even have specialized devices to detect alloys and plating. For new investors, the takeaway is clear. Buy from reputable dealers and learn the basics of coin authentication. Don't rely solely on pictures or certifications from unknown sources. Your best defense against fakes is knowledge and caution. Storage is another often overlooked aspect. If you purchase valuable coins or bars, keeping them safe is essential. Stacker boxes, airtight containers, or a secure home safe can protect your investment from theft or damage. Many investors underestimate how quickly physical metal can degrade if exposed to moisture or improper handling. When it comes to storage, the goal is preservation, not just convenience. A coin that is scratched, corroded, or otherwise damaged loses both collector and resale value, even if the metal itself retains intrinsic worth. Finally, consider the role of the secondary market. Coins and bars are only valuable if you can sell them when needed. A network of trustworthy dealers, coin shops, or online bullion marketplaces ensures liquidity. Relationships with local dealers can be invaluable, as they can alert you to new stock, help you authenticate rare finds, and provide fair buyback offers. Without this, even legitimate coins might be hard to sell, especially if they fall into less common categories or high premium designs. Understanding the risk of fakes, prioritizing metal over collectible appeal, and securing your assets are fundamental steps. They separate casual buyers from serious investors who can protect and grow their portfolio effectively. In the final part, we'll look at some real-life examples of both successes and costly mistakes to highlight the lessons every gold and silver investor should learn. As we wrap up, it's important to remember that investing in precious metals isn't just about buying gold and silver. It's about making smart, informed decisions that protect your wealth. Throughout today's discussion, we've explored how to avoid costly mistakes, from high-premium collectibles to counterfeit coins, and how to focus on investments that maintain real value. You've seen how dangerous pre-1933 gold coins can be if purchased from unreliable sources, how slabbed and graded coins might carry unnecessary premiums, and how raw silver or junk silver offers safer exposure to market prices. Every investor must prioritize understanding the true worth of what they are buying. It's tempting to chase rare or visually appealing coins, but the reality is that the metal content often determines long-term profitability. By sticking to bullion coins, silver rounds, and carefully selected pre-33 gold coins purchased close to spot price, you minimize risk while maximizing potential gains. A $50 silver coin bought at a steep premium might seem exciting, but it may underperform compared to 3 or 4 generic silver rounds purchased near spot. Knowledge, patience, and discipline are your strongest allies in this market. Another key takeaway is the importance of authentication and inspection. Fakes exist in almost every category: gold, silver, and even copper. And while professional graders and high-end equipment can help, developing your own observational skills is equally critical. Understanding weight, texture, markings, and minor design variations can save thousands of dollars. Partnering with reputable dealers and establishing trust with local coin shops gives you an added layer of security and often provides early access to quality inventory before it reaches the broader market. Storage cannot be overstated. Coins, bars, and rounds must be protected from physical damage, moisture, and environmental risks. Proper storage solutions, such as stacker boxes or airtight cases, preserve value and ensure your collection remains liquid when needed. This is not just a matter of convenience, it's an investment in the longevity of your portfolio. Finally, consider your long-term strategy. Metals like gold and silver aren't just collectibles. They are financial instruments that can hedge against inflation, market volatility, and currency devaluation. By building a stack wisely, avoiding excessive premiums, and diversifying between bullion, rounds, and trusted historical coins, you create a portfolio that grows in value while staying liquid and secure. Thank you for joining me today on Gold Rush Reporter. I hope this video has given you clear guidance on avoiding high-risk purchases, identifying fakes, and focusing on smart, metal-backed investments. If you found this video valuable, make sure to like, subscribe, and hit the notification bell so you don't miss future insights on gold, silver, and market trends. Drop your questions or tips in the comments section. I love hearing from fellow investors and collectors. Until next time, stay informed, stay vigilant, and keep stacking your wealth wisely. Gold and silver aren't just metals. They're your hedge against uncertainty. Silver Dragons out.